Let's cover the key risks for Cummins because on the surface it looks diversified and high quality, but the risk drivers are very real and very cyclical. The first major risk is end market cyclicality. Cummins is tightly linked to heavy-duty trucks and industrial activity. When freight demand slows, fleets stop ordering and OEM production cuts can hit engine volumes fast. That doesn't just pressure revenue, it also hurts margins through lower factory utilization and weaker absorption. Second is emissions and regulatory risk. This is one of the most regulated industries on the planet. Standards keep tightening and compliance failures can trigger recalls, penalties, and large cash costs, plus management distraction. Even when Cummins executes well, the regulatory bar keeps rising, so the risk never fully disappears. Third is technology transition risk. The world is moving toward lower carbon solutions, but the timing is uncertain. Cummins has to defend its core diesel profit pool while investing in the next platform: natural gas, hybrids, batteries, hydrogen, and aftertreatment. If the company bets too early or on the wrong pathway, returns suffer. If it invests too slowly, it risks losing share as customers shift. That connects to hydrogen and Accelera execution risk. Hydrogen and electrolyzers are long-duration markets with uneven adoption. Commercialization can take longer than investors expect, and early-stage businesses can produce restructuring charges or write-downs if demand doesn't scale. Then you have competition and OEM bargaining power. OEMs care about total cost and reliability, and they negotiate hard. Any share losses, aggressive pricing, or shifts toward alternative powertrains can pressure Cummins' economics. Another key risk is margin volatility, from materials and labor costs, warranty, and product mix. Even a great operator can see profits swing when volumes drop or costs spike. Finally, watch power systems. Data center backup power demand is a strong tailwind right now, but if that CapEx cycle cools, the growth contribution can normalize quickly. Cummins can be a strong long-term business, but it's not set and forget. Investors should watch the truck cycle, regulatory headlines, and how well management navigates the transition without sacrificing the profitability of the core. Now let's flip to opportunities for Cummins, because this company can look boring industrial at first glance, but there are multiple levers that can line up and drive upside. In the short term, the most obvious catalyst is the truck cycle. Heavy-duty markets move in waves. If North America orders stabilize and then recover, even modestly, Cummins can benefit from volume, better factory utilization, and improved absorption. That's often where margins surprise on the upside, because fixed costs get spread across more engines and components. The second short-term tailwind is power systems. Demand for backup generation and reliability solutions has been structurally supported by data centers and grid stress. If that demand stays elevated, it can offset weaker on-highway cycles and support earnings quality. Third is the aftermarket. Cummins' parts and service business tends to be steadier than new equipment. Even when fleets pause new truck purchases, they still maintain what's on the road. That recurring cash flow can stabilize results and support buybacks or reinvestment through a down cycle. Then you have margin levers: pricing discipline, easing input costs, and operational efficiency. If costs normalize while pricing holds, you get margin expansion without needing heroic volume growth. And that's exactly the kind of setup that can drive multiple expansion when investors regain confidence. Now zooming out to the long term, the biggest opportunity is being a bridge to transition winner. Cummins doesn't need the world to switch to hydrogen overnight. In many regions, the next decade is likely to be a mix: cleaner diesel, better aftertreatment, efficiency gains, and alternative fuels. As emission standards tighten globally, customers often need more technology content per vehicle. And Cummins can monetize that through higher value systems, not just engines. At the same time, energy transition is a real option. If hydrogen infrastructure and fuel cell adoption accelerate faster than expected, or if electrolyzers scale economically, Cummins has exposure to that upside through its transition platform. The key is that investors should treat it as optional upside, not the base case, until adoption becomes clearly profitable. Finally, the long game is mix shift toward recurring service and system solutions. The more revenue comes from parts, software-enabled monitoring, and lifecycle services, the more stable the business becomes, and the more it deserves a higher quality valuation multiple. So the opportunity case is: truck markets eventually rebound, power systems stay structurally supported, and Cummins compounds through aftermarket strength, while the transition platform provides a potential upside call option if adoption accelerates. Here we're looking at EV to EBITDA, a useful way to value a cyclical industrial like Cummins. Historically, the multiple often sits in a mid-range, but it can spike when EBITDA temporarily falls in recessions, like around the financial crisis or other down cycles. What stands out now is the current multiple around the mid-teens, which is higher than many past years. That can mean the market is paying up for quality and transition potential, or it can be a warning that expectations are optimistic if the cycle cools. This chart shows a clear long-term growth story. Revenues expand meaningfully over time, and EBITDA rises too, but not in a straight line. Cummins has operating leverage. When volumes and pricing are strong, EBITDA can accelerate. When the cycle turns, profitability compresses. The recent period highlights that dynamic revenue holds up well and EBITDA improves, suggesting pricing and mix have helped. For investors, the key question is whether this is a sustainable earnings base or a strong point in the cycle. Gross margin is relatively stable over long periods, which signals decent pricing power and cost discipline. Impressive for an industrial manufacturer. Net margin, however, swings much more. That's normal for Cummins because net income captures cycle effects, restructuring, taxes, and other one-time items. When net margin drops sharply, it doesn't automatically mean the business model broke. It often reflects the cycle or special charges. The main takeaway: Cummins looks structurally solid at the gross level, while net results can be noisy year to year. ROIC and ROA tell you if the company is turning capital into real returns. Over time, Cummins often posts mid-teens ROIC in good years, which suggests a durable competitive position, technology, scale, and a strong distribution and service footprint. When ROIC dips, it's usually the cycle or heavy investment periods. The recent rebound is a positive sign. It implies Cummins is earning solid returns even while investing for the future. This leverage chart is a quiet strength. Cummins tends to run with low net debt relative to EBITDA, which gives it flexibility in down cycles, crucial for an industrial company. You can see periods where leverage rises, but overall it stays contained, and it improves again afterward. That balance sheet discipline matters because it allows Cummins to keep investing through the cycle, protect the dividend, and avoid being forced into bad decisions at the bottom. EPS for Cummins is clearly cyclical. You see strong expansions, pullbacks, and then recoveries. That's exactly what you'd expect for a business tied to truck production and industrial demand. What also stands out is that EPS can be distorted by non-recurring items in certain years, so it's important to think in terms of mid-cycle earnings power rather than only one standout year. The big picture is still constructive. Long-term EPS trends higher, but investors should expect volatility. This dividend chart shows a very shareholder-friendly pattern. The dividend per share increases steadily over time. For Cummins, that's meaningful because industrial companies don't always deliver this level of consistency. It suggests management is confident in long-term cash generation and wants the dividend to be a core part of the investment case. The key is sustainability, which depends on free cash flow and cycle resilience, but the long history here is a clear positive signal. Dividend growth starts out very high in early years, partly because you're growing off a smaller base, and then it normalizes. In recent years, the growth rate looks more stable and moderate, which is what you want from a mature, high-quality industrial. Not flashy, but repeatable. If Cummins can keep delivering mid-single-digit to high-single-digit dividend growth through the cycle, that's typically a sign of discipline and real cash generation, not just financial engineering. This payout ratio chart explains a lot about dividend risk. Headlines. When earnings drop sharply in a down cycle, the payout ratio can spike, not necessarily because the dividend is reckless, but because the denominator, EPS, temporarily collapses. Over the long run, Cummins generally keeps the payout at a reasonable level, which supports dividend durability. So the way to read this is, spikes are usually cycle-related. The real question is whether cash flow holds up enough to bridge those periods. Let's quickly look at the analyst rating mix because it gives you a snapshot of Wall Street sentiment, but it's not a guarantee of returns. Here we have 4 strong buys, 7 buys, 11 holds, 0 sells, and 1 strong sell. So the overall tone is moderately positive but not euphoric. The large number of holds usually means analysts see the company as high quality, but believe a lot of the good news may already be priced in, or they want clearer visibility on the next leg of earnings growth. What's also interesting is the lack of regular sell ratings. That often reflects how analysts treat strong franchises. They may downgrade to hold instead of sell, even when they think upside is limited. So the takeaway is simple. The market consensus is cautiously optimistic, but the stock likely needs either better than expected fundamentals or a more attractive valuation to trigger a wave of upgrades from hold to buy. If this breakdown helped you, Please hit like, subscribe, and drop a comment. Your support really helps me make more of these analysis videos. Thanks for watching, and I'll see you in the next one.